You are not going to hear about this from traditional means. Look at me on paper. I am not supposed to succeed. I'm a horrendous student. Moved to Tokyo with nothing. I don't have a job. I don't have any place to live. No financial background. I was knocking down the door of every single financial institution. Goldman Sachs noticed. 22 interviews later, I'm trading futures and options. Goldman literally hired a homeless person off of the streets. Me. It is my duty to tell you about these other pathways. Do not be intimidated by people who work in financial institutions. Most of all, do not sell yourself short and underestimate yourself. We're not trading market. We are trading with or against ourselves. When your actual money is on the line and shit hits the fan, observe yourself. Look in the mirror, not be trading. Assume that every single job will be gone. If you're specialized in one thing, you're putting all your eggs in one basket, and when the day comes where that automation takes your job away, it's your fault for having concentrated to one profession. Do not follow traditional means. Don't be ordinary. Definitely don't be extraordinary. Be extraordinary.
All right, friends, here it is. Upon overwhelming requests and demand, following my last release on my personal trading and markets framework, this is the full version of my presentation that I recently gave to the investment club at Temple University's Japan campus. And that extends into my personal history, my very highly unconventional background, and story of how I got into finance at age 28, picking up and moving to Tokyo with nothing, getting hired by Goldman with zero on-paper qualifications and accolades and experience, and my advice and commentary, more so, on careers in finance in an era of constant and perpetual change and disruption. Okay? Very highly unorthodox, maybe even controversial commentary, but it's based on my lived reality and experience. And to my followers, to my supporters, to my subscribers, past, present, and future, this is for you, so that you know where I am coming from and who it is that you're listening to when you're consuming my market commentary and content. For better or for worse, you need to know, I need you to know. Okay? So, once again, I'm starting off with a clip of Charlie Rose interviewing Lloyd Blankfein, then CEO and chairman of Goldman Sachs, in 2014, and then straight into my full presentation to the investment club at Temple University Japan campus.
How far out into the future do you think you can see?
Well, I'm in the risk management business, so I don't take it for granted that I can see behind. I don't think I can see 4 inches into the future. Yeah. I'd say that most of my...
Yeah, but your firm has a reputation of being pretty good at understanding the future and being able to make some analysis as to about what risk to take.
Well, I'll confess to you that what I think we aspire to is less foresee the future and more be a great contingency planner. And sometimes if you contingency plan really well and you can respond very fast to what's happening because you thought through all the possibilities, you can get off the mark so quickly it looks like you false started. It looks like you anticipated the start when all you've really done was listen so closely and knew what you were going to do that you got off the mark quickly. I think it's hard enough to predict the present. Yeah. You know, think about it, perspective. It's very hard to step out of your context and see what is happening. I have views about the future, but I'll tell you, we're not in the business. You wouldn't be a very good risk manager if you let what you think was going to happen have too great an influence on what you plan for and protect it against. What we really do is we really contingency plan. What might happen, what could happen.
Charlie Rose, as you mentioned, he's not like an idiot.
How far out into the future do you think you can see?
He's a smart guy.
Well, I'm in the risk management business, so I don't.
And he asks, "How far in the future do you think you could see?" I mean, come on, that's like a kindergarten type of question, right? But that's the level of what the perception is, what people think trading is about. And what does he say? He says that you can't predict the future, you can't predict the present, meaning. When he says, I can't predict the present, what he means is things that are happening right now. If you look at markets right now, and if you see dollar yen suddenly falling, okay, that's the present, that's not the future. And to explain that move, it's very difficult to do. And that's what he's talking about, let alone what the dollar yen is going to do 2 seconds from now, 2 months from now, 2 years from now, okay? But Goldman is not in the business of doing the impossible. They're not in the business of predicting the future. They're in the business of thinking of every sort of scenario that could happen and being ready for it so that if and when any of those things happen, they can immediately respond. And when they do that, from the outside, it looks like they had anticipated that whatever event. But instead, what they did was they just contingency planned. They thought of all these, sort of downside risks, upside risks even, and then pull out the manila folder and they execute that plan, okay? That is how markets work. That is how your career and life will work, okay? So that's what I want to start with. And just to show you an example of what he means, this is not just a talking point, okay? I'll show you exactly how this is put in practice. Does anyone remember, is anyone from the US at all? No? Yeah? Where are you guys from? South Carolina. Connecticut. Cool. From the US? No? Okay. I'm from New York originally. I used to live in Williamsburg, Brooklyn. Does anyone remember Hurricane Sandy? Hurricane Sandy was a pretty big storm that hit New York City, and it not just New York City, but New York, New Jersey, Connecticut, that whole area, and it wiped out the power. And it's kind of eerie to see, this is the skyline of Manhattan, and it's pretty crazy to see something like this, right? You've never seen like the entire skyline just kind of blacked out. The reason that these pictures had to be taken, like that right one, in the daylight is because there is no like city lights going on, as you can see on the left. That's what Hurricane Sandy did, all right? Now, on the entire island of Manhattan, of New York City, however, there was one building that happened to be lit up during Hurricane Sandy. Does anyone want to take a guess as to what that one building happens to be? Does anyone want to take a guess as to what company that is? That is Goldman Sachs worldwide headquarters. That is 200 West Street, okay? They were the only ones with power. Why? Because of contingency planning. Goldman has their own power that is off of any other grid, independent of anything, powered off of, I don't know how it works exactly. But they thought of this. They thought of a Hurricane Sandy. They thought of an entire like Manhattan, like New York City, everything like grid system gone, and how to keep the building powered and fully powered, as you can see. This is not like some small, like trailer or something like that, okay? This picture is a very famous picture. This exemplifies exactly what Lloyd Blankfein is talking about. This is contingency planning, okay? This is right before the storm hit. That's the entrance to 200 West Street, and you can see that they piled sandbags all the way up to like here. And people were thinking like, I remember this, people were thinking like, what the hell are they doing? This is ridiculous. Well, look at the right side of the screen. That's why they did that. And you can see this flood and the level it goes to up on that car. I mean, they even like got that height correct, right? Goldman Sachs is not washed away in Hurricane Sandy. So, contingency planning, okay? And by the way, Goldman is not in the business of staying dry during hurricanes. They're in the business of financial markets, okay? This is like a side thing, but they have thought of not everything, but if this is how they operate just on like weather basis, imagine what they're doing in terms of financial markets and risk management, okay? What makes Goldman, and they're not the best firm, whatever, but what makes them like have that reputation is because, as Lloyd Blankfein said, they are the best contingency planner, and because they also know that they cannot tell the future. Other people might think that they can tell the future and say like, this is going to happen in the future, and I'm going to put a trade on. I'm going to allocate capital this way or that way. I'm going to do this and that, okay? Lloyd Blankfein is smart and not humble enough, but he's smart enough to know that you cannot let too much of what you think is going to happen dictate how you actually maneuver sort of markets. And again, this applies to all of your careers as well individually. So, who am I? I am a horrendous student. That is my first year in college. Those are my grades, okay? I've basically been at the very bottom of my class for my entire life. I was like in the bottom 5-10 percentile in terms of academic grades. And the minimum GPA to graduate from my college was a 2.5, and my final GPA was a 2.501. All right, so yeah, that's as close as it gets. As you can see, however, my best grade here was Intro to Microeconomics with a B-. Now, it's not because I was like stupid or anything like that. It's just because I was lazy. I didn't care. I didn't care about school. I used to work in the music industry. I knew I was going to work in the music industry. College was, to me, was something that you just do after high school. I got a degree in sociology. Sociology is the type of degree that you get where you don't have a career path in mind. You just need a piece of paper that says that you went to college. That's what a sociology degree is. Sociology is like the study of stuff. That's what I did. And I got a 2.51 GPA at that. So I am not qualified to work at a financial institution. So I knew nothing about finance. I didn't know what bond yields were. I didn't know and I didn't care, okay? In 2008, I graduated in between when Bear Stearns and Lehman Brothers collapsed. Fantastic time to graduate. However, the way that it worked was if you tried really hard, if you were one of my peers who went to Harvard, you got straight A's, you worked your ass off your entire life, or you were me, and you just, partied and played guitar and stuff like that, there was no difference because we're graduating into a horrendous recession. So nobody's hiring us anyway, right? So we graduate into that. And then Lehman Brothers suddenly goes bankrupt and the entire world ends. And it blew my mind, right? Because in what world does that happen? If Apple went out of business, if Apple went bankrupt, yeah, that's going to disrupt some supply chains. It's going to disrupt like the economy of Northern California, but it's not going to. The world's not going to end, right? Lehman Brothers going bankrupt. That was a cataclysmic event. We were teetering on the edge of a cliff, looking into the abyss, and that's when I realized, holy shit, pardon my language. Holy shit, this whole world of finance, this is a more powerful institution than anything else. It's more powerful than governments. And you know why I say that? Because these financial institutions went to governments and said, governments, we need money. And they said, okay, have as you want. And they did. And they did so at the expense of everybody else who is not in finance. So you tell me where power lies, right? That's what really made me pay attention and sit up and realize this is the industry, this is the area that matters more so than anything else. You can work in any other industry, marketing, you can work at a shoe store, you can have a small business, whatever it is, it doesn't matter. Because if the people that move green and red blinking tickers around the world for a living, if they mess up and it causes like global contagion, everybody will be impacted directly. All right? So my view at this point, when I was watching all this happen, and discussed it as I was about bailouts and all that, but I don't get emotional about that. I'm just very pragmatic, and I realized, okay, for the sake of job security, I need to get into a too big to fail bank. That's the only sort of secure thing that there is. Everything else is at the whim of these too big to fail banks. However, it's very hard to do in a recession with accolades like this. Fast forward to 2013, Abenomics is launched in Japan. That's where I see my one opportunity to get into institutional finance because I realized that there's going to be a ton of foreign capital flooding into Japan. I can exploit my Japanese last name, and I'm a salesperson, kind of by nature. I can talk to people. So if I just basically go to Japan physically, go to Tokyo, it doesn't matter what job it is. Like if I can just land some sort of job where I am helping or servicing foreign investors gain exposure to whatever financial instrument or product, whatever it is, it doesn't even matter because I don't know anything anyway. That's my one long shot chance to get into a too big to fail bank in order to have job security. So what I did was in January 2014, I got on a one-way flight to Tokyo. I basically packed up, I uprooted my entire life in New York, my beloved friends, my family, all of that stuff, and I moved to Japan, to Tokyo, with nothing. One suitcase and one carry-on bag, because they allowed one carry-on. And I was capsule hotel hopping around. I landed in Meguro, and I didn't know it at the time, but I ended up staying at what I found out later to be a love hotel. But I didn't know at the time. This was just the cheapest one at the time. And it was also during Juken season, so I had to keep moving every single day because every single student was taking up all the cheap hotels. And I was living off of 7-Eleven dinners and all that. But what I was doing was I was knocking down the door of every single financial institution with a presence in Japan, and that's basically everybody, and saying, look, I don't have a job, I don't have any place to live, I barely can speak the language, I have no financial background, I have no idea what anything is in what you guys are in need of or anything like that. That's what I basically have come to Japan with. That was 10 years ago. Of all firms, Goldman Sachs noticed. They thought that I was a very unusual probably an insane person, but an interesting sort of candidate because they've never seen anything like this before. So I had an interview at Roebling Hills on the 48th floor of the trading floor. 22 interviews later, I am trading futures and options at the Goldman Sachs Tokyo listed derivatives trading desk. Between that JAL ticket and that business card is about 6 weeks. So what they did was Goldman literally hired a homeless person off of the streets. Me. And not a homeless person in like the Will Smith from Pursuit of Happiness type of smart homeless person. Look at me on paper. I am not supposed to succeed. I'm not supposed to be smart enough to do that, right? How in the hell did I turn that into that into that? So that's what we'll discuss, but it's not about me. I want to apply this to you guys and show you a different angle, a different world that you are not, like I said, you are not going to hear about this from traditional means. It is my duty, personally, to tell you about these other alternative pathways and that there is no such thing as a cookie cutter way into finance and around financial markets themselves. So I worked at Goldman and then I went to Jefferies Japan. Jefferies at the time, Jefferies Japan was basically a non-existent institution in Japan. It's a global financial institution outside of Japan, but they were going to build up like the Japan office and presence. And so it felt like kind of joining a startup, but with the backing of an existing multi-billion-dollar investment bank. Thought it was very interesting. So I went to hedge fund equity sales at Jefferies. Hedge fund equity sales or equity sales in general is basically our analysts will say, we have a buy rating on Sony or whatever. We've upgraded Sony from hold to buy, and we've increased the price target from 700 yen to 900 yen, and earnings per share from this to this based on our fundamental research and all that. Equity sales is the person who is basically what I call cut and paste sales. We just relay that information to the buy side, to clients, to the investors. What you're supposed to actually do, though, if you're not just a cut and paste salesperson, is you're supposed to actually give your own market opinion with that research. So what we do is, this is kind of like how finance works now. You don't actually just call clients anymore. Yeah, I mean, some people do, but you're supposed to enter your ideas, your trade ideas or your trade recommendations individually into what looks like almost like a paper trading sort of platform. And you have to monitor that. You have to say like, okay, long Sony, short Panasonic or whatever it is. This is like the length of the trade, like for about 2 weeks out. Here's the catalyst. Here's the reason why we're opening it. Here's a stop loss. Here's where we take profit and all that kind of thing. And you actively manage that. Every single person has to do that, okay? So the 10 people, my colleagues on sales desks sitting next to me, as well as competing firms. At Nomura, at my previous firm, Goldman, at Morgan Stanley, everyone does that, right? And they're all servicing these clients. And at the end, they aggregate everyone together and they give their rankings. Take a look at my rankings, okay? These are various funds. They're all different kinds of strategies. A lot of these are very massive hedge funds. If you look at my rankings, they are consistently up there, okay? I'm not the number one person, but I'm in the top 10, okay? Basically the inverse to what I was grades-wise. So from, once again, that into this, outperforming the street, okay? None of this that I'm saying is me bragging, all right? I want to be clear about that. I'm not saying like, look at my accomplishments. What I'm trying to illustrate to you is that do not be intimidated by people who work in financial institutions. Do not be intimidated by the financial institutions' brand names themselves, and most of all, do not sell yourself short and underestimate yourself or your background. Because if I can do that, and I'm just a normal person, I'm not anything special, I'm not smart or whatever, right? If I can do that to that, then you guys are far more prepared than I am, okay? I did this flight when I was 28 years old. I don't know how old you guys are, but you guys seem younger than that, okay? So that's my background. Does anyone have any questions so far about my background? You can interrupt me at any time. You can ask me anything. I'm very transparent. Okay, so you're asking me how I got into Goldman, right? So here's what happened. So at Goldman, amongst my 22 interviews, which is an obnoxious amount of interviews. Like, honestly, if you're gonna do, anything after 10 interviews, what are you gonna find out at interview number 16 that they haven't, but they will pull managing directors off the floor during trading hours to do this. It's kind of insane, but Nonetheless, that's how they are. So they would ask me, like, they would say, like, look, Weston, you're a smart guy. You clearly are an ambitious person, but we accept 2.5% of applicants we give job offers. That makes us more than 2 times harder to get into Goldman than to get into Harvard. And by the way, I would never obviously be able to get into Harvard University. Why are you going to be one of those 2.5% that gets the offer? Why should we give you the job and not any of those who are far more on paper qualified? And what I said to them was, you're going to give me the role because of this, because I have a 2.16 GPA, because of my 2.16 GPA. In other words, if you are and this now applies to all of you who might be kind of self-conscious about Temple University, which like I told you is a very highly regarded university, so you shouldn't be. But in case you are, what I said was, if you are 25 or whatever, and you have a piece of paper that says MBA from Harvard Business School, or even a CFA or something like that, right? Then your mindset and your thinking is going to be, well, I can do whatever I want. So why don't I try out Goldman if I get the offer? And if I don't like it, I could go to Morgan Stanley or go to a hedge fund, or I could go to McKinsey, or I could do anything that I want. And it's totally true. They can. Okay. However, if you, Goldman, if you give me the role, I don't have a put option. I don't have an insurance policy. I don't have anything else. I have back to the Meguro Love Hotel homelessness. Okay. So those people with those degrees, ironically, they are being handicapped by them. They will never know what it's truly like to be genuinely hungry, motivated, and driven to succeed. I have one option. That's it. Succeed or be homeless. Okay? I have nothing else. So what I offer you is my shitty GPA and my ambition to come here with nothing. And in terms of like learning about markets, all that kind of stuff, believe me, I can learn at a faster pace than they can. Let's put the intellect thing aside. I will have a drive and a work ethic that you will not have seen before, because you have never seen somebody like me or somebody do this before. And that's one of many reasons that I basically got it. Also, because I'm not institutionalized, because I didn't go through the entire system of being the undergrad, the MBA, the internship, the analyst associate program. Because I didn't do all that, I'm coming in with a fresh perspective, which is how I'm able to do things like this and outperform, because everybody here is thinking exactly the same, and I'm not. So that's how I got in. It's because I stood out, right? I always talk about this word extraordinary. Extraordinary is a funny word because it's literally spelled extraordinary, okay? You do not want to be ordinary, and you definitely do not want to be extraordinary, but you do want to be extraordinary, okay? I'm not saying I'm extraordinary in like a pat myself in the back sense. I'm saying that I'm a weird, unique individual. Every one of you will have your own sort of unique, sort of things. You have to figure out how to exploit that and sort of present that rather than blend in like the Boston Career Forum sea of black suits and everybody is exactly the same carbon copy of one another, okay? Now more than ever. All right, so that's basically kind of my career path, and I'll get into more of that later, but like it really overlaps with trading. I guess we get to like sort of trading, markets, and all that kind of thing. This is how I approach markets work. In a nutshell, it's kind of actually very simple in concept, not in practice, but in concept, okay? This is how I look at it. There are these 4 outcomes from a trade or investment. You could have a big win, you could have a big loss, you could have a small win, and you could have a small loss. And by big and small, I mean like the percentage of your portfolio or the notional size of it or something like that. Now, small wins and small losses, those will cancel each other out. So they don't really matter, okay? You made 3%, you lost 3%, they don't really matter. So that leaves these other 2, these big wins and these big losses. And this is what makes the difference between Ken Griffin or a Steve Cohen or some other major, massive, legendary hedge fund manager who makes billions of dollars year after year after year after year, double-digit returns year after year. Paul Tudor Jones, here's what makes the difference. It's not the big wins. If you can eliminate big losses, then you're left with what? You're left with big wins. So investing, trading, I don't care if it's crypto, I don't care if it's a private equity deal, I don't care what it is. Your small wins and gains, they don't matter, Okay, they matter in the sense that, like, yeah, you can learn from them, and yeah, they might matter in a material sense. But what you really have to pay attention to is the left side of the column. And that left side of the column, the big wins, you cannot control that. Okay? You cannot control that because remember what Lloyd Blankfein said, you cannot tell the future. Okay? Big wins happen by luck. Big losses you can control if you mitigate them. If you can protect your capital, if you can risk manage, if you can stop the amount of losses that you have and preserve your capital, you will not have any big losses. And if you eliminate small wins, small losses, and big losses, then by default, at some point, you will be left with big wins. And when you have those big wins, understand that they are not a product of you getting those big wins, but that's a product of you avoiding big losses enough for you to stay alive long enough in the game to recognize those big wins. Okay? Does that make sense at all? Am I? Yeah. Okay. Trading losses. This is another thing I always talk about. Everybody gets the same markets in macro, okay? We all get the same USD JPY cross. We all get the same crude oil futures. We all get the same spot BTC, whatever it is. We all get the same markets. But then why is it that some make billions and others lose everything and then some in the same exact markets? It's because we're not trading markets. We are trading with or against ourselves. That's the differentiated factor amongst everything. Because the constant are the markets. Why do we have such a huge, disparity of outcomes on either end? And it's because it's not the markets that we're trading. We're trading with or against ourselves. What do I mean by that? I mean what you have to learn about in terms of investing, in terms of markets, more than anything else, is this. Learn who you are first and always, okay? If you're new to investing, welcome. And by welcome, I mean welcome to the club. We are all new to investing. If we have 30-year-long careers in investing, every single day, we don't know what's going to happen, and therefore, every day, we are new to investing. Markets are extremely, extremely fair, if you think about it, because we all get the same markets. We don't know what's going to happen at the end of the day. So every single day, we're all on kind of the same sort of starting line. I don't care if you're a hedge fund with all the resources of the world or if you're an individual investor, retail investor, or whatever. You don't know what's going to happen at the end of the day, okay? So don't worry about what other people know above you. Don't worry about, like you said, an edge that you might or might not have, or that other people might have over you. Forget all that, okay? The biggest thing that you have to find out and learn about is who are you? And the only person that can answer that is you. And you might not even be able to answer that. And if you do answer that, you have to keep updating. This is what I mean by that. If you invest in a stock, okay, let's say this investment club, you guys decide that Toyota is a buy and you think that there's 50% upside. And you did 5-year DCF analysis and it's going to go up and blah, 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 blah. And then Donald Trump gets elected and he says 1,000% tariffs on cars from Japan. And naturally, Toyota, Nissan, all those stocks fall 60% in market open, okay? And let's say you guys just bought long Toyota just the day before with this bullish target, and the stock falls 60% down, day after day after day, limit down, limit down, limit down, and open 60% down. What are you gonna do? Are you gonna buy more? Are you gonna cut your losses because Trump is still tweeting things like we're gonna even do more and blah blah blah? So the thing is that there is no right or wrong answer, but what you have to find out is who are you in that scenario? Are you sweating bullets? Are you freaking out that that's happening? That is valuable information you need to know. You are learning that you are somebody who sharp losses is something that you can't do, and so maybe you have to outsource that to someone else. Or if you're the type who will look at that as an opportunity to buy long or buy into that, that might be something that you could use to your advantage, or if you do it sloppily, you could just keep buying into a falling knife and you can lose everything. Either way, you have to learn who you are because, once again, we all look at the same exact markets. What you have to really learn is, who am I? This is something that I do all the time, too. Who am I in markets, right? My wife, for example, I made her start investing in crypto, kind of dollar cost averaging in. But I did that because, and I told her, it's kind of an experiment. I said to her, I want to observe what kind of trader you are. I want to see what happens, if BTC falls really sharply. Are you going to be sad about it? Are you going to be depressed? Are you going to be bullish? All of that, right? because I want her to find out who she is in markets. This is what all of you have to do. This is the most important thing, okay? You have to find out. And the way that you find out, the only way that you find out is when you have actual capital in markets, when you are an actual market participant. Not paper trading, not anything like that, but when your actual money is on the line and shit hits the fan, or if the stock gets short squeezed and you're up 50% in a day. Let's say you blasted through that Toyota target the next day. Are you going to take profit? What are you going to do, right? For me, the way that this is just personally to me, and so don't apply it to you because this is only for me. If I am long something, let's say an options position, and let's say it goes up 3x or whatever it is, my goal always is to protect my capital, right? Eliminate the big losses. So my goal is not to always like make a profit. My goal is to try to own whatever it is or have that position for free. In other words, I'm trying to get to a point where I can take my initial investment principal amount off the table, and that way I'm just playing with house money, and then I don't give a shit what happens, right? And it actually gives me sort of more flexibility, mental flexibility, to be able to withstand gigantic up and down swings and all that. But my primary goal isn't to like make X amount or whatever. My primary goal is to be able to take my initial capital off the table, get it out of markets, protect my capital, cross out that big losses, bottom left corner red box, and that will set me up for, at some point, hopefully, big wins. But those big wins happen because of that. But that's just me. That's not for everybody. You have to find out who you are, and you do that by actually participating in markets. Classrooms, reading books, seminars, all that, yeah, that's not helpful, but it could also be not helpful because it's going to give you false confidence that you think you're ready or whatever. No, just dive in. I don't care if it's with 100 yen. Pick a stock. I don't care what it is. Invest in it. Okay, you can do it commission free on like Monex and SBI and all that. Buy a stock. I don't care what it is. And when that stock goes up or down, don't judge yourself on the performance of that stock. Judge yourself on yourself. Observe yourself in that process. You have to look in the mirror, not at the trading screen, okay? And you have to do that over and over and over throughout your trading and investing career. I don't care how many decades of experience you have. This is always going to evolve too, right? There are hedge fund managers who used to take a lot of risk, who could stomach it. Now they are almost like giant mutual fund asset management collectors, and they have very low volatility sort of funds, and they are now just asset collectors. And so they've changed their ways, right? That's what you have to do. That's what's the most important thing. Learn who you are first and always. Always, always, always. Career advice.
Okay, so I actually forgot to mention one of my key philosophies in this presentation under this like trading losses topic, so I'll just do that right now. So when it comes to like losses, trading losses, P&L losses, profit and loss, P&L, profit and loss trades. P&L losses in trading are not actually losses if you can have some sort of takeaway or if you can pull some sort of lesson to learn from doing that trade, right? If you can extract a lesson or gain some personal or technical insight, then the monetary losses aren't losses at all. It's tuition. It's market tuition. But if you don't learn anything new, or if you don't have any takeaway whatsoever, and then you're just left with the monetary P&L loss, then therefore it is pure and simple a loss. Okay? Always try to find some sort of lesson or a mistake or discover some personal flaw or I don't know, whatever it may be, but try to extract something out of it to not repeat again or to improve upon, to make your red and green, or in this case, red and red blinking ticker loss worth it, and never pay that tuition again, or pay less in tuition upon incremental improvements. And if you could do that, then by that approach, it's entirely possible for one to never actually have a trading loss. So market losses themselves, they're not only inevitable for everybody, but they are critically necessary. Right? Nobody is immune from the wrath of markets, and the best traders with solid and consistent sustained track records have taken more trading losses than the rest of us, but they turn it into tuition, and that's why they survive onwards to become legendary. Okay, so this is a Michael Jordan quote that encapsulates this idea. And by the way, I don't know if this is a real quote or not. I don't care if it's real or not because it speaks volumes, okay? He says, I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I failed over and over again in my life, and that is why I succeed. That is very powerful, but that applies to many things, and it absolutely applies to trading markets, okay? Like I said, the biggest and most successful traders have losses in terms of size and quantity that you wouldn't believe. Tuition costs, okay? The tuition costs are very real when it comes to markets. And the thing is that no matter how successful one may get in trading, there's never a time like where you're just done with paying market tuition. As in, there's never a time where you're now immune from losses. Losses will always be there. If you're going to be in the game and stay in the game, you have to pay to play. Okay? So it's a matter of minimizing the size and the frequency of tuition costs, i.e. that big losses, lower left-hand corner, red box that I was talking about earlier in the presentation. Okay? So that's that one more point that I want to add about trading losses to the presentation.
Career advice. Somebody reached out to me and asked me the following, and I asked them if I could use this as an example because it's really good, okay? This is what they said. Hi, Weston. I've been following your content for a while. I really appreciate the time and effort that you put into it. I learned a lot from discussions. I would like to get some career advice, given that you used to work in sales and trading at Goldman. I'm currently working as an investment bank analyst covering sector, but I've got a huge interest in macro, and so I'm considering a switch into sales and trading. An opportunity has come up to join an institutional rates sales team internally, which sounds like an exciting opportunity. However, I have been advised by a number of people not to take a sales seat since it'll limit my options later on, and it will be very difficult to move to a buy-side seat. I was keen to get your thoughts on the move and also on the future of sales and trading as a career. Are there any asset classes you think that have the most opportunity over others? My thinking is that illiquid and structured products are the area to be gravitating towards, given that they will be harder to automate, and hence you are more likely to stay relevant in either a sales or trading role. Thanks. Here's what I responded. I really can't advise on others' career paths, and I'm talking to you guys too, okay? My response to him is my message to you guys. I can't advise on career paths, okay? Not only because I don't know what I'm talking about, but also because the more general notion of nobody other than yourself knows what's best for you. That goes back to what I was just saying about trading, okay? I can't tell you about career paths. Nobody can advise you on that. That's a personal thing, just like trading is. As per written right there, quote, don't take a sales role because it'll limit options to move to the buy side later. Okay, well, why is the moving to a buy side later assumed to be the ultimate goal? You said that it sounds like an exciting opportunity to you, right? So that should be what guides your decisions or your path, rather than someone else's own views of what an ideal career path looks like. Also, by the way, I don't have the full context, but this, quote, sales role equals difficult to go to buy side is very much nonsense sounding to me for someone who wants to get into the buy side. Sales roles give you direct personal exposure and interaction and relationships across a wide array of buy-side clients daily. So if you do a good job, plus buy-side needs someone, you won't even have to do any formal interviewing because they already know you personally and they know how you work, etc. And then I say, I would agree that structured products are harder to automate, but that doesn't mean that they're immune from disruption. I guarantee that currently, every single day, there's a ton of time, capital, and effort out there aimed at doing just that, which is disrupting. And it's not just going to throw the towel upon itself. If anything, maybe you should look into being on the disruptor side of growth rather than being the prey. And I'd also say that for me personally, I would and have based my career path on what I want to do rather than avoiding something else, okay? Because he's saying this is the less worse option. What I'm saying at the end there is my career path has never been avoiding what's worse than this. I'll take the less worse. No, it's go towards something. Don't run away from something, okay? And then he says, thanks a lot, Weston. Really appreciate it. I think you're spot on with the sales role. You are literally talking to the buy side daily. And if market color trade ideas that you bring them over time is valuable, then I'm sure that the doors would open and move into a portfolio manager seat. The concept of being the disruptor side of growth is a great way of thinking about it. I've never looked at it that way before, but I definitely should do. Thanks a lot for the great advice. Okay. There's so much covered in here that's why I want to use this as a perfect example. The first thing is, like I just said, this is purely your decision. Don't listen to somebody giving career advice. They don't know what they're talking about because they're not you, okay? Only you know, and you might not even know yourself. And that's perfectly fine if you don't know yourself. But if you don't know yourself, how in the hell is anybody else going to know for you? They can have the best intentions, but they're just projecting what their vision of an ideal career path is, okay? So that's the first thing. Second thing, in terms of automation, all that. So you guys are about to enter an industry at a time where, forget AI even, there's so much disruption. Assume that every single job, every job that you guys know of out there will be gone in 5 years or less, okay? And if I'm wrong about that, that's fine, but assume that every job that currently exists out there, white collar job, not just in finance, assume that you will be replaced by a machine or a piece of code or something like that, okay? So what the hell are you gonna do? Well, contingency planning. That's why I brought that up. Throughout history, from the caveman days to now, the path was specialization, right? If you're like in a caveman group, this guy is like very good at like slaying woolly mammoths, so he's part of the hunter team. This guy's good at building fires, so do that, right? And collectively, as a society, you get together, and specialization, the better you do, the more you survive. And then if you apply that to modern day capitalism, I am the greatest neurosurgeon of all time, therefore I am paid the highest amongst my peers. I'm the best tax attorney of all time. Okay, well, what happens when some robot comes and replaces your best neurosurgeon in the world thing? You're out of a job, and you're out of your expertise. And not just that, but if you are the best at whatever, that means that you have devoted no time to doing anything else, and therefore you have nothing. You have nothing left. You're basically like a professional football player who didn't know how to read because all he did was just train all of his life, who just broke his leg and left with nothing, right? So instead of focusing on specialized one thing, what you need to do now, in my view, is you need to diversify, just like a portfolio, have a broad array, a wide array of differentiated, diversified career paths and scenarios to look at. If you're specialized in one thing, you're putting all your eggs in one basket, and when the day comes where that automation comes and takes your job away forever, you are left with nothing. And it's your fault for having concentrated and specialized into one profession. Instead, if you are always constantly out there looking for what am I good at, what can I do, it doesn't even matter if you enjoy it or not. We don't have the luxury of like enjoying our jobs. What areas am I good at, and what can I do, and what can I not do? You have to constantly explore that, and that's the only way you can be a good contingency planner, and that's the only way that you're going to survive the inevitable catastrophe of massive permanent layoffs and permanent unemployment that's going to hit our generations thereafter. And it's going to continue. It's going to keep changing too, right? There's no such thing as a 40-year career at a job anymore. Those days are long gone. So that's what you're walking into, okay? Now, to conclude, this might sound like I'm just giving like a very doom and gloom thing, and I don't want to sound like that. I am extremely envious of you guys. I am extremely envious, and I think that you guys are on a fantastic opportunity, okay? Because if you're my age and older especially, and you have been ingrained in one sort of career in finance, if you've been doing M&A or whatever it is all your life, there's no exit. Like, that's all you can do, like I said. But you guys are not like already ingrained in something. You're not like stuck in some sort of thing. You can do whatever. You can do things like this. You can just pick your life up and go. I'm not saying like physically go somewhere, but you can do all of that. The reason I was able to do that was because I was 28, and people would say like, well, aren't you like worried about going to Japan and having nothing there? No, what scared me was not doing it, and one day being 50-something years old and stuck and looking back and saying, man, I wish that when I had that chance, I wish I would have taken that chance and got to Japan. Obviously, I wasn't going to get Goldman, but maybe that would have set up a chain of events that would have got me, this and this, rather than just stuck in New York. Well, this is where you guys are right now, okay? Whatever job that you think that you're going to have, think about it from how is it going to be disrupted, because it will be. Think about how you want to either be on the side of defense, where you're trying to keep your job, or think about how can you innovate and disrupt, right? How can you apply AI to investment banking, to M&A, to consulting, whatever it is? Do those middlemen need to exist anymore? Whatever it is, look at it from that angle and you guys have that blank sheet of paper, clean Etch-a-Sketch to work off of, and you're not ingrained like everybody else. That's why I think that it's a fantastic time for you guys, but it's critical that you know that. Do not follow this is the way it's done. Temple University is like a subordinate university, and no, that is not true, and it doesn't matter. And it certainly doesn't matter now more than any other time because of how much structural change is happening. And at the end of the day, if I can do that, not everything is possible, but nothing is impossible. Okay? People say, like, you can do anything is possible. No, that's not true. Not everything is possible at all. I can't be in the NBA. I can't play professional golf. However, nothing is impossible. Don't be ordinary. Definitely don't be extraordinary. Be extraordinary. All right? So that's it. Does anyone have any questions? I know that was a lot. Don't think of it like you guys are privileged to not be at the Todais of the world. If you are, you're expected to be, following the career path. But if you're not, you have the flexibility of not follow this is the way it's done. So the same mentality that I have for like investing and trading. Someone says like, the earnings are going to be this, so the stock must do this. Must it? The Fed must cut rates or hike rates. Must they? Why? Based on what? Because of the rules of the game? Or no. Look, again, nothing is impossible, right? So you have to think outside the box and think of these contingency, like XYZ happens with your career, with the markets, and then you have to execute on that rather than saying, this is what's going to happen and therefore I don't have to think about other scenarios. That is setting up for failure. If you think you're going to get a job and you're going to be happy working, you're setting up for being shocked when you get laid off. If you get a job, good for you, congratulations. Now contingency plan. What happens if you get laid off? Citi, Morgan Stanley, Goldman, Barclays, Bank of America, Wells Fargo, Fidelity, and like 5 other financial institutions all laid off employees in the last 6 months. BlackRock cut staff, or UBS cut staff, and then they did $1 billion buyback, share buyback. Could have used that $1 billion to keep staff on, but it's not their job to keep you employed, right? You have to think of those scenarios. And in that particular scenario, by the way, if you work in a public company, if you own stock in that company, and you feel like you're getting laid off, right? Like if you work at Google and you get paid in Google shares, something like that, and you feel like you're about to get laid off, what you need to do is you need to actually top up and own more shares of Google because you are getting laid off so that the stock price can go up. So be the beneficiary of you getting laid off. Be that hedge, right? That's what I call like owning your enemy. But it's just, again, contingency planning. That's a way of contingency planning, right? Cross out the big losses in terms of your career, in terms of markets. So what do I think of Tesla stock, of trading Tesla stock? Yeah. Thanks for bringing this up. The way that I look at markets in general is the green and red blinking ticker is what I say that you're investing in. I actually turn around and I look at the behavior of the capital because TSLA shares in and of themselves, what makes that go up and down? Money in or out. That's it. That's what makes any market go up or down. More money in than coming out, price goes up. More money out than in, price goes down. That's simple. So I haven't looked at Tesla recently, but I don't care about Elon Musk's earnings call. I don't care about their earnings at all. I don't care about their PE. I don't care that they keep slashing the prices on their Model 3 or whatever it is. I don't care about their China sales. I don't care about any of that. All I care about is green and red blinking tickers and the behavior of capital that impacts that. So what's going to make Tesla go up? More money in than out. What's going to cause more money in? I have to look at options activity because so much of Tesla has been driven by speculative, like massive notional quantities, sizes of options traded. But yeah, you have to understand like the dynamics of markets to understand the behavior of capital. If it seems like it's already owned for the most part, what other incremental buyers are there? Is what I would say, right? Like if you haven't owned it already, who's gonna now own it? Somebody who's forced to own it, driven by options, gamma activity, hedging behavior and all that of dealers that people are trying to exploit and like short squeezes and all that kind of stuff. But you've already been included in the S&P 500. So where that incremental buyer would come.
So I honestly think that, Tesla's the only company on the planet that can...
That's fine. What does that have to do with the green and red blinking ticker TSLA? But
300. So.
right, but your question you're asking me is you're not asking me about whether or not the car is nice and if I should buy one of those cars, which my wife and I drove and I love them. But you're asking me about green and red blinking the ticker TSLA. Yeah.
Full self-driving.
Yeah, but how much of that is priced in? Yeah, so if that's your view, you just have to make sure that even if that's what you believe, it doesn't matter what you believe, it doesn't matter what I believe. All that matters is what the masses of capital believes. So you have to take a view on, are they going to believe that, right? Not what do we believe. Like we might believe, we might have 100% faith in that. That's not the way to approach it. The way to approach it is, are people going to be convinced about that? Is the public going to recognize and realize that? Is capital going to recognize and realize that such that it'll be allocated into the stock from here on out? That's how you have to look at it. Behavior of capital, right? Behavior of other people's capital, not necessarily our belief in it. That's how I would approach it. Not just Tesla, but anything. But again, I don't care. I really don't care really what it is, because I just care about what the behavior of capital is. If they think it's toxic, if they're not going to touch it for whatever reason, take Facebook and when they turn to Meta, that switch, right? That kind of bigger vision, I believe in, but like look what happened in the short term. They got decimated and Sheryl Sandberg left the firm and all that kind of stuff, right? So like those are all things that, it doesn't matter what I really believe in or not believe in, it's whether or not the kind of public will believe in that. And you have to detach the real world from the green and red blinking ticker. Tesla, the company, might be the greatest thing in the world. Apple Inc. might be the greatest thing in the world. AAPL, TSLA, MSFT, those have nothing to do with the businesses that share the name with it. They just simply don't. Especially with like index, with the S&P 500 index that's mushing everything into one cluster, right? So that's the behavior of currently the markets. So that's how you have to look at it, right? Yeah.
I guess one more question. You
Yep.
mentioned, based on everything that you said, probably it's nothing to do with what you think about crypto in the future, right?
No, my wife trading thing was, it didn't have to be crypto. It could have been anything. It's just that crypto is something that you can trade at any time, and she works during the day. So if I do that during like market hours, she's like, but I wanted to pick a purposely volatile 70 vol asset because I wanted to see like what is she gonna do when it crashes, or when it rallies.
Right. So there you have it. That's my story. That's my outlook. I hope you found it to be helpful, if not interesting, in your own individual ways. And at the very least, you now know where I'm coming from in my approach to markets and the unique views and commentary that I put out there. Now you might know where that might stem from. If you'd like to receive my market analysis and content and support Across the Spread and help build this platform, which I started and am building out with and for my core supporters, who I serve and interact with, please go to my Substack page. The link is in the description, or you can just go to acrossthespread.com. If you find any of this to be helpful and would be interested in this type of content about my personal experiences, thoughts, my reflections on these matters, let me know by hitting the like button. And on behalf of Across the Spread, my name is Weston Nakamura. Thank you for watching. We will see you soon.